Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, Zan Akbari with the Dividend stock for your shopping list. Christine Benz talks with Kevin McDivitt about where fund investors are putting their dollars this year. Special guest Mark Miller discusses whether working longer should be part of your retirement plan. Alex Bryan on whether you should invest abroad. John Barrett with a new high-quality stock for your watch list. And Matt Dolgen finds attractive ideas among data center stocks. Let's get started. First, Zan Akbari with the Dividend stock for your shopping list.
Currently at a roughly 3% dividend yield and about a 20% discount to our $27.50 per share valuation, we think dividend investors should consider narrow moat Kroger despite ongoing concern about traditional grocers as their digital rivals grow. We believe Kroger is different from its pure-play peers in that it should be able to use its scale, customer insights, and strong private label offering to successfully complete its transformation into an omnichannel grocer. While competition should remain fierce as Amazon expands its grocery offerings, Walmart executes its own digital strategy, and hard discounters Aldi and Lidl expand in the United States, we expect Kroger can use its cost leverage to meet downward competitive price pressure while maintaining margins. Fairly steady profitability against low single-digit top-line growth should allow the company to maintain its streak of 13 consecutive years with dividend increases, mostly recently continued by Kroger's move to raise its payout to about 14% to an annualized 64 cents, starting with the planned September payment. Our forecast assumes mid-single-digit dividend growth over the next decade, somewhat slower than the last 10 years' low double-digit clip, with Kroger distributing roughly a quarter of its earnings annually, particularly as we believe Kroger's investments to build its omnichannel presence will ebb slightly as a percentage of sales, and as store growth should not be a major part of the story, we believe projected cash flows provide a significant margin of safety around the dividend while also allowing the firm to continue share repurchases. Although acquisitions could cause Kroger to deviate from our forecasts, particularly as it looks for partners to build its omnichannel presence and develop new ways to monetize its customer insights, we expect the firm to continue to focus on steady, though admittedly not outlandish, dividend growth in the years to come.
Expand your investing horizons and look to the long term with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patek as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. Next, Christine Benz talks with Kevin McDivitt about what types of funds investors are buying this year.
Hi, I'm Christine Benz from Morningstar.com. U.S. passive fund market share hit 40% in the first half of 2019. Joining me to discuss some themes from Morningstar's fund flow data is Kevin McDivitt. He's a senior analyst in Morningstar's Manager Research Group. Kevin, thank you so much for being here.
Thanks for having me, Christine.
Kevin, let's discuss this passive flows juggernaut. It's something that you have been observing for a number of years, and really it continues unabated, where we see investors very strongly indicating that they're preferring passive products.
Yeah, it's really across the board. I think for a while people thought it was really just kind of confined to equity funds and U.S. equity funds in particular, but it's really across the board. It's all asset classes, maybe with the exception of municipal bond funds.
Okay, so you think that this is largely driven by the fact that the complexion of fund ownership is changing a little bit underneath the surface. So you've got more managed portfolios that are making decisions. You've got more advisors making decisions on behalf of investors. Let's discuss some of those secular forces that are driving the interest in the assets into passive products.
Yeah, I think that's really a huge part of it, what you identified there with that interest in managed portfolios, whether you're talking about an advisor putting a client into a managed portfolio or an individual investor investing through a target date fund. A lot of those portfolios are using passive products. And you see that demand in just kind of if you look underneath the asset classes and look at categories, you can see that all the demand for U.S. equity is going into large blend. Again, kind of that core strategy. With international equity, all net demand is going into foreign large blend funds. Again, a core holding, diversified emerging markets, which I think are a bit of an anomaly, but I think that's reflected in the fact that a lot of advisors see emerging markets as somewhat of a separate asset class. Within taxable bond funds, again, you see intermediate term core bond, intermediate term government, all those core strategies, that's where all the net flows are going.
Okay, so it's not just that investors are saying no to active, they're saying no to some of the satellite holdings that perhaps they used in the past. So they're not using large growth and large value indexes. They're just saying, I'm getting my US equity exposure via this total market index, for example.
Yeah, right. Although, to be clear, they are saying no to active as part of that process. But yes, I think that's really the underlying theme there.
Okay. And you say that the fact that some of these decisions are being driven by different entities, not just individual investors themselves, has kind of changed the behavior before our very eyes, where we used to kind of see this performance-chasing fund investor. We're in some cases seeing kind of contrarian patterns. Let's talk about that.
Yeah, it's really a stunning development. As you and I both know, having been in the industry a long time, it's such a different world from what you saw perhaps 20 years ago, a long time ago. But back in the day, during the first dot-com bubble, the way investors would throw money at whatever hot manager was new on the scene, you don't see that really at all now. And again, kind of that contrarian piece you mentioned. So in the fourth quarter of last year, when you had a pretty serious correction, US equity funds actually had inflows of about $50 billion. But then you look at this year, where you've had a very strong market. The S&P is up, 21%. But inflows for the first half of the year are only about $17 billion. So far less demand this year when the market is way up compared to the fourth quarter of last year when the market was way down. So it's really a stunning reversal. I think that, again, speaks to just the power of these managed portfolios, how investors aren't focused on returns, which is a positive thing.
Okay, so if I own a target date fund and my manager is buying and selling on my behalf, one thing that might be happening with the equity piece is if they're targeting, say, 60% equity for that portfolio and stocks go down, they're buyers in that environment.
Yeah, exactly. I think that's exactly the dynamic. It's rebalancing that's driving demand rather than performance.
Okay. How about in fixed income? Are you seeing kind of a similar pattern prevail? What are investors doing in terms of their fixed income choices? Do you see a similar sort of contrarian mindset, or is it a little bit different?
Yeah, I mean, for the most part, the strongest flows are still going into those core strategies, those core categories. So again, intermediate term bond, whether it's government or kind of broader focused, maybe investing in some credit too. Those are the strongest categories, but you do see more breadth with taxable bonds. So you are seeing strong demand, for example, with high yield bond funds. I think they've gotten about $15 billion or so this year in inflows. So that's the only area where you're seeing some breadth in terms of demand is taxable bond.
Okay. And how about the active passive bifurcation there? Are you seeing the same theme where investors are generally going with the indexes, or are they giving a little more room to active managers here?
Passive is still dominating there. Although there is a bit more, you are seeing some flows going into active. And again, to the extent that credit-oriented strategies are doing well, those tend to be more on the active side. So I think of like PIMCO Income, which is kind of a quintessential active strategy. It's a multi-sector bond fund, and it's gotten about $14 billion in inflows to lead all active bond funds this year. But I think that's partly driven by the fact that credit is doing pretty well this year. So you're seeing some flows to active bond funds, but overall passive is still dominating there.
Okay. And then in terms of the providers that have been thriving in this environment, it's all the passive shops that you'd think of, right?
For the most part, although you're right, all the demand is certainly coming from the passive side, with Vanguard leading the way, close to $100 billion or so in inflows so far this year. iShares has been very strong with about $60 billion. But right there is Fidelity, which is, again, for those who've been in the industry a long time, it's weird to think of Fidelity doing well, but it's all their passive products.
Because we think of them as an active shop, but they are selling a lot of passive stuff, and they do a good job on managing passive investments.
Correct. And you're right. I mean, all the demand is on the passive side. Their active strategies on balance are in outflows.
Okay, Kevin. Always great to get your perspective, kind of explore this intersection between investor behavior and what we're seeing and where they're putting their dollars. Thank you so much for being here.
Thank you, Christine.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now, special guest Mark Miller discusses whether working longer should be part of your retirement plan.
I'm Christine Benz from Morningstar.com. Working longer can make a lot of financial sense, but it's not achievable in every case. Joining me to discuss that topic is retirement expert Mark Miller. Mark, thank you so much for being here.
Hi, Christine.
Mark, let's talk about working longer. When you look at labor force participation rates, we do tend to see older people are staying in there a little longer.
Yeah, I mean, that's really the good news, is that a lot of people have gotten the message about the value of staying in the workforce longer in terms of bolstering retirement security. And of course, with a really strong economy, there's labor demand, and so more people are finding the ability to work is there. More employers are starting to figure out that, maybe I better figure out ways to keep my older workers, employed and happy, because they need workers. So that is a, really dramatic change from certainly back, during the depths of the Great Recession, when older workers took it pretty hard in terms of job loss there.
It took them a long time to replace the jobs that they lost.
Yeah,
too,
so we are, exactly. So we're seeing higher labor force participation rates across the board, but definitely among older workers too.
Okay, so let's discuss the financial positives for workers in terms of staying in there. Why might people consider this as part of their retirement planning?
Yeah, I think it's one of the most powerful levers you can pull in terms of your retirement plan and improving your retirement security. There's several reasons for it. One is you're going to have fewer net years of life that have to be funded out of your retirement assets, and more years that are funded through work. It sets you up to delay your Social Security filing, and as we've discussed often, that's really positive. You get 8% additional benefits for every 12 months that you delay, give or take, starting at 62 when you can file, up to 70, which is the last year in which additional credits are available. I mean, netted out, it can be like a 70% boost in your monthly Social Security benefit across that span. So that's huge. It can mean more years of socking away money in a retirement account, and these are years where you can do the catch-up saving. So for some households, maybe some expenses are in the rearview mirror now of college tuition and the like for kids. Can be years where you can sock away a lot more money. So in several different ways, it can really be very, very powerful. So it's a great aspiration.
Okay, and you often make this point: great aspiration, not necessarily a plan.
Right.
So let's talk about how there can sometimes be a disconnect, and the data show that there's a disconnect between someone's stated desire to retire at X age versus when they actually do retire. What do the data show?
Yeah, so I mean, the scariest thing I hear from people is, my plan is I'll work forever.
Yes.
This really worries me, because the data show that 40 to 50% of people wind up retiring earlier than they projected or planned to do. And that happens for a variety of reasons. So, it is a terrific thing if you can pull it off, but you need to also have a plan B, I say.
Okay. So a variety of reasons: health considerations, or maybe spouse health considerations.
Health is a big one. Job loss still is an issue, even though, as we were discussing, the economy is strong.
Right.
Burnout. People tend to underestimate, their ability to just hang in if it's not work that they love. And then, it's interesting I interviewed a researcher for a story on this who's taken a close look at the survey data on why people wind up leaving earlier. And what he said something interesting. Is like, these reasons that you and I were just discussing only really explain maybe a third of the early departures. He says there's a whole lot going on out there that we don't have a good handle on, that's harder to measure. So, those are the reasons some of the time, and other things happen.
Okay, more work to be done there. But let's discuss what's in the toolkit for people, and I think this describes a lot of pre-retirees. They're looking at their portfolios, maybe they've seen them nicely enlarged, but they're still worried about a shortfall.
Right.
So what are the other levers that they can pull? Working longer might be one piece of it if they can, but what other things should they think about?
I think one thing that's worth thinking about is thinking carefully about your career trajectory as early as, let's say, age 50. Think carefully about, is this a job that I think I can stick with to whatever my projected retirement age is or not?
Right.
If not, think strategically about a change. Maybe you should be changing employers or the career you're doing, or do you want to go off and do something independent where you have more control? There's a lot of interesting work being done out there by people who specialize in this part of it, kind of career strategy for midlife. I've written a lot about it.
Yes,
others
you have
too. And so I think I would start with that. But beyond that, I think plan B is just save as much as you can, because that's your cushion.
Okay.
And then, you might, if you were able to save enough that, let's say you have to leave the workforce earlier than you hoped, you might still be able to delay that Social Security filing by living off of some of those savings for a few years, bridging it, if you will.
Important topic, Mark. Thank you so much for being here to discuss it with us.
Thank you, Christine.
Thanks for watching. I'm Christine Benz for Morningstar.
Next, Alex Bryan discusses whether or not to invest abroad.
Hi, I'm Christine Benz from Morningstar.com. Foreign stocks have underperformed U.S. over the past decade, and some investors may be wondering whether to stay the course. Joining me to share some perspective on that question and a few fund favorites is Alex Bryan. He's Morningstar's Director of Passive Strategies Research in North America. Alex, thank you so much for being here.
Thank you for having me.
Alex, let's revisit the case for investing overseas. Many U.S. large caps are global businesses, and foreign stocks do bring some risk to the table in that they are denominated denominated in foreign currencies. So you pick up some risk there. Why should investors still globally diversify their portfolios with foreign stocks?
Well, I think it's really important to diversify internationally because U.S. stocks, while they have had a really strong record over the past 20 years or so, they do go through stretches of underperformance relative to international stocks. And so even though international stocks do tend to be a little bit more volatile than U.S. stocks because they are priced in foreign currency, if you add a small part of your portfolio and park that in international stocks, that can actually help diversify your local economic risk. It can help diversify interest rate risk, currency risk. So when you think about diversification, it's important to think beyond just diversifying across individual stocks, individual sectors. You should also think about diversifying across different markets. A lot of times people say, well, don't I get enough international diversification with U.S. stocks? It is true that a lot of large cap U.S. stocks are global. Based on Morningstar data, U.S. Stocks in the S&P 500 generate about 62% of their revenue in the U.S., but international stocks actually still have less exposure to the U.S. market. If you look at the holdings of Vanguard Total International Stock ETF, they only generated about 15% of their revenue in the U.S. over the past year. So you do get a lot better market diversification in terms of where the underlying stocks do business by diversifying across both U.S. as well as international stocks.
Okay, so let's talk about right-sizing positions, right-sizing allocations to foreign stocks. If I look at foreign stocks, they compose a little less than half of the global market capitalization today. Some investors might say that seems like too much foreign. How much home country bias is reasonable, and how should I sort of approach that question about how to allocate to foreign stocks?
Yeah, so I think there's not a uniform answer for every investor. It really depends on, I think, your level of risk tolerance. When you do add international stocks, you are going to pick up a little bit of volatility from the currency risk. But I think a small allocation of about, a quarter to a third of your portfolio shouldn't have a huge impact on the overall portfolio's volatility, because even though that one piece of your portfolio might be a little bit more volatile, because international stocks aren't perfectly correlated with U.S. stocks, the diversification benefits help offset that added volatility. And overall, it doesn't really increase the risk all that much. But if you are a more conservative investor, you're not quite as comfortable with some of that currency risk, you could consider either allocating a smaller portion of your portfolio to international stocks, or going with something like a currency hedge fund, which tries to strip out the volatility that might come from the currency risk. But I do think it is reasonable for U.S. investors to still have a little bit of a U.S. home country bias, but even the most conservative investors should probably have a little bit of their assets parked in international stocks.
Okay. So you touched on the hedging question, the currency risk question, Alex. How should investors approach that question? Because now there are very low-cost products that do hedge their foreign currency exposures. How should investors navigate that? Are they losing anything by going with a hedged U.S., hedged international product, even though they may be lowering risk?
So the main trade-off here is really twofold. Number one, currency hedged funds do tend to charge slightly higher expense ratios than unhedged funds. And if you think about currency risk, if you're a long-term investor, currency fluctuations tend to wash out. They, over the very long term, generally don't have a huge impact on returns one way or the other. They do, however, add to some volatility. But if you want to take that risk off the table and you're comfortable paying a slightly higher fee, currency hedging might be a way to go. The other trade-off, in addition to higher fees, is that currency hedged products tend to be a little bit less tax efficient. In other words, they're more likely to make capital gains distributions because they do have to roll their contracts forward, and they may have to realize capital gains in the process. So it is a little bit less tax efficient, but if you are more risk averse, that still may be a good way to go to take some risk off the table.
Okay, and perhaps hold that hedged international fund in some sort of a tax deferred account where I'm not feeling those extra capital gains distributions.
Exactly.
Okay, so let's get into some ETF picks, perhaps for investors who are revisiting their foreign stock exposures, given that we have seen foreign stocks underperform. Let's start with a very plain vanilla core type fund. This ticker is VXUS. It's a Vanguard fund.
Yes, this is the Vanguard Total International Stock ETF. This one basically owns stocks of all sizes listed outside the U.S., so it includes both stocks listed in foreign developed as well as emerging markets. So this is a good one-stop holding for international stocks, basically. It gives you everything outside the U.S. I like this one because it's a very low-cost fund. It charges 9 basis points. It's also fairly tax efficient. It's low turnover. It's never made a capital gain distribution. And it gives you really good diversification. It has very good diversification across both sectors, regions, stocks. So if you're just kind of looking for a good passive core holding, I think this is a good one to start with.
Okay, let's look at a smaller cap international fund that you like. And first, let's talk about the thesis for even looking at small cap international stocks.
So, I think one of the benefits of investing in international small caps is that small cap stocks tend to be more highly levered to their local markets than their larger cap counterparts. So you do get slightly better diversification benefits, I think, with small cap stocks than you do with large cap stocks that happen to be listed in foreign markets. So I think that's really the main benefit here. Something like Vanguard FTSE All World X US Small Cap ETF, ticker is VSS, is one of the cheapest international small cap funds available, charges 12 basis points. And it includes stocks that are listed in foreign developed as well as emerging markets. And a lot of the small cap stocks in emerging markets tend to be more consumer oriented. They're less likely to be state-owned enterprises. So you get a little bit more clean exposure to those local markets. So if you're trying to benefit from some of that growth in emerging markets, I think smaller cap names are going to give you better exposure to those than some of the larger cap names that happen to be listed there.
Okay. And finally, let's talk about a fund that does hedge foreign currency exposure. So for investors who want to try to reduce the volatility level, the risk level in their international stock holding, let's share an idea for them.
Sure. So Xtracker's MSCI EFA hedged equity, ticker is DBEF, is a good currency hedged option. Now, this fund only invests in stocks that are listed in foreign developed markets overseas. But I think if you're going to be a currency hedged investor, it makes sense to really focus on the foreign developed market because the cost of hedging is lower there than it is in emerging markets. One of the factors that determines how expensive it is to hedge is the interest rate differential between the U.S. and the market where you're looking to hedge. Right now, interest rates in most developed markets are fairly low, so it's actually pretty inexpensive to hedge your currency risk there. If you were to try to apply a currency hedge in emerging markets, it can be more expensive to do that. But I think this is a really good option for investors who are looking to take some currency risk off the table. Like I mentioned, this does charge a slightly higher fee than some of those unhedged funds that we talked about. This fund charges 35 basis points. That's still fairly low compared to actively managed alternatives, but it is a bit higher than some of those Vanguard funds that we talked about.
Okay, Alex, it's always great to get your perspective. Thank you so much for being here.
Thank you for having me.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Now, John Barrett shares a new high-quality stock for your watch list.
Last month, we initiated coverage of narrow moat Coupa with a fair value estimate of $116 per share. We think the business is resonating with customers and has the opportunity to grow revenue 30% over the next few years. But with stock trading above $140 per share, or roughly 19 times 2019 revenue, we do not think that this is an attractive entry point for investors. Coupa is a cloud-based procurement and expense management platform connecting over 1,000 customers with over 4 million suppliers. Coupa's platform assists customers from the procurement of goods through to invoicing and reconciliation of purchase orders. Coupa's platform helps customers save money and gain more control over their spending by pushing employees towards preferred vendors and managing supplier relationships. The company's main competition is SAP and its combination of acquisitions Ariba and Concur. Coupa boasts strong user metrics with net retention rates over 110% and gross renewal rates near 95%. As a clear indication of the platform's utility, Coupa's customers have more than doubled their average spend on the platform since 2016. Management has set a goal to grow revenue over 30% over the next 4 to 6 years, which we believe is attainable. We think revenue growth will continue to come from onboarding new customers, but that the company will also have an opportunity to increase pricing as well as cross-selling to existing customers. Lastly, we think that the recent introduction of its Coupa Pay module could provide an opportunity for Coupa to take a cut of transactions flowing through its platform, which would represent a large opportunity. While we like Coupa and we think that it has carved out a narrow moat for itself, we think that it is modestly overvalued at these levels.
Expand your investing horizons and look to the long term with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patek as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. And lastly, Matt Dolgen with an attractive idea among data center stocks.
We recently took a deep look at the data center industry, and it reinforced our views that the firms holding network-dense properties are best positioned. Several secular trends are driving an increase in demand for data centers, and that's likely to continue. Among the growth drivers are increased use of the cloud, artificial intelligence, and the Internet of Things. However, we see many data centers as undifferentiated, so with an abundance of capital chasing the growth, only data center providers with unique portfolios are likely to see attractive returns. We call data centers network dense when they have many different network service providers connecting into them. Typically, only a couple facilities in each city are network dense, and they would be very difficult and costly to replicate, so the firms holding them have a big advantage. Network density attracts other networks and cloud providers, which in turn attract their own customers, leading to a network effect, the strongest moat source we see for data center firms, and a moat source we've assigned to CoreSite and Equinix. Digital Realty also owns many network-dense properties, though they are often overlooked in its huge portfolio and its historically different business model. However, Digital Realty owns a lot of valuable land in many places, and it's the landlord for companies like CoreSite and Equinix. Many data center stocks have had big runs in 2019, and we'd hesitate to chase them. We think they're fully pricing in the growth drivers. But the long-term story is real, and CoreSite, Digital Realty, and Equinix have sustainable competitive advantages. So whenever opportunities present themselves, which they often do for data center companies because of near-term tenancy fluctuations, we think they're worthy additions to a portfolio.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you've enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.